Stock Dividends Basics Problem 2. Grape Corporation reported the following equity section on its current balance sheet. The common stock is currently selling for $14.75 per share. Common stock, $13 par, 113,000 shares authorized, 41,000 shares issued and outstanding, $533,000. Paid in capital in excess of par common, $159,000. Retained earnings, $390,000. Total stockholders' equity, $1,082,000. What will be the balance in the common stock account after the issuance of a 10% stock dividend? Okay, dividends. So let's take this in steps. First, determine what kind of dividend is involved. So what would be the balance in the common stock account after the issuance of a 10% stock dividend? We're not dealing with cash dividends. We're dealing with stock dividends. Remember, if it doesn't say stock dividend, it's a cash dividend. If it's a stock dividend, you will see that. You will see it in the actual question prompt. So with that, we're asked about the common stock account. Now, in a previous problem, we were asked about stock dividends, and it was real simple because the answer was the same before and after. There wasn't really a lot of calculations, but I still broke it down for you. I'm going to break it down for you here as well. Remember to look at stock dividends, understand what's going on, think about the balance sheet. Assets equals liabilities plus stockholders' equity. Stockholders' equity is broken into two parts, paid in capital and retained earnings. And remember our trusty little sidekick, WIRE. W-I-R-E. It's probably getting ingrained to your head at this point, kind of getting annoyed. Withdrawals, investments, revenues, expenses. Withdrawals decrease stockholders' equity. Investments increase revenue and expenses. Revenue increases, expenses decrease. Paid in capital, that's where we find the I. That's where we're issuing new shares of stock and whatnot and related transactions. The retained earnings, we have W, R, and E. And remember, for a corporation, the W is known as dividend. So cash dividend, stock dividend, it's going to reduce retained earnings. It's going to reduce retained earnings. And one thing we talked about in a previous problem is that a stock dividend, you're reducing retained earnings, but then you're also increasing paid in capital because you're issuing new shares of stock. Now, specifically, in this question, it's only asking for the common stock account. The common stock account. So that means we're only looking on this side, which means that common stock is going to go up by a stock dividend. Retained earnings would go down, and then the paid in capital account or paid in capital side of stockholders' equity would go up. So it's not going to be an easy one where it's the same before and after. No, that is not the case, unfortunately. Unfortunately, that is not what's going to happen. All right, let's take a breather. The common stock is currently selling for $14.75. Is that going to be important? No, that's not going to matter in this problem. What is going to matter is we're focusing on common stock account, and we have a 10% stock dividend. It's the only type of stock. What is going to matter is we have a $13 par, and we also have 41,000 shares issued and outstanding. Now, when we're doing calculations, we're going to be using the 41,000 shares issued and outstanding. We're going to ignore the 113,000 shares authorized. So keep that in mind. It's very important. It's very important. Okay, so the way we calculate this, we're going to take the par value, or the par amount per share, I should say, which is $13. So we take the $13 par. We're going to multiply that by the percentage stock dividend. So here it's a 10% stock dividend. We're going to multiply it by 10%, the stock dividend percentage. That gives us $1.30 per share. So per share. Now we're going to multiply by the number of outstanding shares. The number of outstanding shares, which is 41,000. So multiply $1.30 by 41,000, and we're going to get the total amount to add to paid in capital, which is going to be $53,300. So $1.30 per share times 41,000, $53,300. We're going to add this to the previous common stock account, which is $533,000. The $533,000 amount, which is the common stock before this transaction. We're going to add those two numbers, $533,000 plus $53,300, and we're going to get $586,300. And that is our end answer. That is how much common stock is going to be after the issuance. Now remember that this is the increase, this $53,300, this increases the common stock account. Specifically, that's where we're looking at common stock, and which is in paid in capital. Retained earnings is going to go down. So retained earnings goes down, paid capital goes up. It's going to balance out. So stockholders' equity is still going to be equal before and after, but you're moving money, you're moving the amount, not money, but you're moving an economic amount, not money, right? You're not passing cash or anything. You're moving money from retained earnings to paid in capital, and that's why it equals at the end, because retained earnings is going to go down, paid in capital is going to go up. So that's how we calculate the total after. Again, we're adding this $53,300 for the new common stock onto the old common stock balance, and then we get $586,300, and we are done with the problem.